Austro-French Center for Rapprochement in Europe. And we have chosen a topic for this afternoon's discussion, which deviates a bit from what we usually have on the agenda, but it should be a very interesting one. And I'm very happy also that we are doing this together with the Vienna Institute for International Economic Affairs and Sciences Po in Paris, who are our co-organizers. Now, the topic, the EU's post-COVID fiscal policy, will it unify or divide us, is an interesting one from my perspective, because some might say you are talking already about post-COVID fiscal policy when we are still in a way in the midst of it, and when output in the Eurozone is not expected to return to pre-COVID levels before sometime next year. Nevertheless, I think the fiscal challenge is related directly to the COVID pandemic, and the way to the future is one which is directly linked. And we have seen at the beginning of the COVID pandemic, of course, a mixture of policy measures taken on an unprecedented level, both from the ECB, but also at the national level, and obviously also in a big new step at the community level, at the European Union level, with the New Generation Europe, which is something people have called as a new avenue in the EU's road on integration. Some have even called about the Hamilton moment, and others, of course, see it more as a one-off thing and want to make sure that this is not sort of in a way creating a precedent for EU fiscal policy at the European Union level. On the other hand, of course, the measures taken at the national level, at member states level, were also unprecedented in a way, and have led to the fact that the fiscal framework, the rules and regulations within the European Union and the Eurozone had to be suspended in order to enable them. So the question, of course, is what is the future outlook for the European Union, both in terms of implementing the New Generation Europe, which is linked to, in a way, to the green agenda and also the digital agenda of the European Union. And on the other hand, how do we get back to a fiscal framework sustainable in the longer term, but also taking into account the fact that member states are widely divergent from their starting points now and in the future, and what can be done to marry this necessity for sustainable finances, public finances, with a need to promote competitiveness, investments, and implement the future-oriented policies. Now, the starting point, and I think the reason why we started to discuss about today's webinar, was that in France, a discussion on public finances started already a while ago, when Prime Minister Castex mandated Jean Arthuis and to create a commission to look at the future of public finances. And in fact, we have two members of that commission present today. One is the person chairing the session, Thomas Wieser, and the other one is Natasha Waller. And as I say, it's a starting point. France will not necessarily set the tone for others, but it's worthwhile looking at what the Commission focused on. And I'm very happy to have Thomas Wieser with us, who will, as I say, chair the panel and who will introduce the panel. He is familiar to many, I'm sure, of those watching today's event. He came originally from the Ministry of Finance, where he was Director General for International Affairs, for Economic Policy and for Financial Markets for quite a few years, before he became first concurrently chairman of the EFC, the Economic and Finance Committee of the European Union, and then for many years until 2018, also the chair of the Eurogroup Working Group. He had different functions in the past, which are also linked partly to today's subject. He was the chair of the Financial Market Committee of OECD at some time. He chaired an expert group on Capital Markets Union, and he is currently also a non-resident member of Bruegel. With that, I would hand over immediately to Thomas and wish you an interesting and stimulating discussion. Thank you very much.
Many thanks, Dietmar. And I should add that Dietmar was my predecessor as Director General in the Finance Ministry. So he knows more than any of us about the intersection of economics, politics, and finance. And for today's meeting, and I will be very short now because I think Dietmar has well explained what we're setting out to do. What we're trying to draw out today is a bit of the politics that we will be facing in 2021, 2022, 2023 on how fiscal policy develops over the next months and years, and not only how it develops in individual countries in absolute terms, but will there be divergences in approach? Will there be a greater degree of coordination and cooperation? Will we manage to find a more common approach than we used to have to the future path of fiscal policy, to future roles? And that, as Dietmar has said, will also be significantly influenced by how Next Generation EU, how the recovery and reform programs unfold, where we have high hopes, but there are, of course, implementation risks, which might not only have an economic impact, but also have political ramifications. And with a view to that, I think we've been able to put together probably the best panel on these questions that we could manage to find in all of Europe. First off will be Marco Butti, who at present is head of cabinet of Commissioner Gentiloni in the Commission. And previously, for many years, he was Director General of ECFIN, and we have been joint combatants on fiscal issues and many others for many decades. Natasha Valla, she has also been pre-introduced by Dietmar as a member of the Jean Arthuis Commission. She is Dean at Sciences Po in Paris, the School of Management and Innovation. And the third panelists, I'm introducing them in the sequence that they will be speaking, is Guntram Wolf, who is the director of Bruegel. According to nearly every sondage, one of the most preeminent think tanks we have, not only in Europe, but beyond. We will have a sequence of not too short, but not too long introduction by each of the three panelists. And we have until 3:15 in order to wrap up then the meeting. After the first round, you will be able, the three of you will be able to react to each other to get things going and try to also bring out the differences in approach possibly. Then I will be constantly watching the chat function where you, our guests from Europe and beyond, I know there's somebody joining from Texas even, are invited to post your questions, and I will try and select the most, let's say, vivid and pertinent ones and put them to our discussants. I will be silent now to give more time to substance, and with that, I turn to Marco.
Thank you very much, Thomas. Thanks to Dietmar. Nice to see you all, and many thanks for the invitation. I think we the idea of taking a political economy view to the reform of the fiscal rules and to fiscal policy, I think is a good one. What I would like to do is to cover 31 years in 10 minutes. 31 years is 29 back, going back to Maastricht in 1992, and 2 years forward. Okay, back 29 years. What was the underlying logic of Maastricht? 5 points, essentially. First, there is a deficit bias in economic and monetary union. We have dispersed fiscal authorities, one monetary authority. In order to avoid fiscal dominance, we will need to have rules, disciplining rules, which would, let's say, prevent pressure of debt monetization on the ECB. First point. Second point, on the experience of management of fiscal policy, automatic stabilizers are good, discretionary fiscal policy are bad. This is the second point. The third point is that there is the treaty limits of 3%. Member states should create space under the 3% to, especially to let automatic stabilizers work. This would take care of asymmetric shocks. The ECB, on its part, would take care of the symmetric shock. Things would work fine like that. The fourth is the consequence of this is that negative coordination suffices. So there is no need of positive coordination. You do you actually implement these rules which are of the proscribing nature, so they prevent from doing certain things. They are not of the prescribing nature. So this is the fourth principle. And the fifth one is that deficits are, as a flow variable, are the operational variable to implement the system. This is 29 years ago. So what do we, how do we judge that based on the experience over those years through the financial crisis and now to the COVID crisis? So I take the 5 points in turn. The first one, yes, the spillovers related to debt are relevant. However, what we have also realized is that you have spillovers related to demand shocks. And actually, and here is something that I have said and written in the past year or two, actually there is a risk of fiscal dominance via excessive fiscal restraint, to the extent that if you have demand shocks, negative demand shocks dominating, you have inflation very low. If you do not use fiscal policy sufficiently, you actually put the ECB with shoulder against the wall in, let's say, a guarantee in price stability. So this is the reversal of the classic fiscal dominance story. The second one, on discretionary fiscal policies and automatic stabilizers, the experience is that under, let's say, large shocks, discretionary fiscal policy can work. And this has actually been proven in the past year and in the present time. Second, automatic stabilizers are good, but not good enough, in the sense that they are, first of all, they are backward looking. You know, you have unemployment benefits kicking in is when you have lost your job. So they are backward looking. And second, they are actually the operation of choices made for insurance and allocation reasons. So for and for redistributive reasons, they are not necessarily optimal from the point of view of cyclical stabilization. So this is the second point. The third point is that a failure of pro-cyclical policies of the past year is that the space under the 3% has not been created by member states, first point. Second point is that under large shocks, whatever space you can create that is, let's say, politically viable is not enough to respond to large shocks. You can go towards close to balance, and we have seen the experience behind us is that you need much more, say, room for maneuver to respond to large shocks. And clearly, one cannot expect to go to 4 or 5 percent of GDP surplus in order to cover for that. Fourth, negative coordination is actually not enough, and under certain circumstances, positive coordination is needed, and positive coordination is coordination between member states, horizontal coordination, and between the EU level, Eurozone level, and the national level, which is the, let's say, the vertical coordination. And here I come to something which actually has been inspired by Lucio Penck. I don't know if Lucio is amongst the audience, and it is an incompatible trinity which reads as this: you cannot have at the same time proscribing fiscal rules, monetary policy at the effective lower bound, and no central fiscal capacity. So this is you cannot have these three elements at the same time. And when you have, as in these cases, in these past several years, not only under the pandemic, monetary policy actually hitting the zero or the effective lower bound, and you do not have a central fiscal capacity, then you know where the triangle gives in, and it is on the non-implementation of the fiscal rules. You come to today, and what we have, how have we lessened this trilemma is by okay, monetary policy doing its best clearly, and with suspending the fiscal rules and with the general escape clause, and creating a sort of a central fiscal capacity, even though not at the euro area level and not on a permanent one, which is next generation EU, Dietmar alluded to at the beginning. Fifth point is which on, let's say, deficits. Deficits have proven clearly very procyclical as an operational variable. You know, you meet easily headline targets in good times. You have to run procyclical policies in bad times. So we have tried to alleviate that by making it more intelligent. But here comes what I may call the Visser dilemma, which Thomas actually uttered at one of the Euro Working Group dinners, and we sat beside there. So I mean, I listened to that firsthand, which is you can either have simple rules, but then you need to have quite a lot of discretion in implementing them, or if you want to have less discretion, then you have to have you need to have very complicated rules. And I would transform this into the Visser plus dilemma, and the plus I added myself. And actually what we have ended up with is the worst possible situation, in which you had very complicated rules, and nonetheless, because you, as we know in economics, you cannot have a complete contract, we also had a very a large degree of discretion. So the dilemma actually combined the wrong poles of both on both corners. I have covered the 29 years. I look 2 years forward in the next couple of minutes. Okay, we will restart the review of the fiscal rules after the summer. So in autumn, you know that we started the review of the fiscal rules back in February, before the pandemic, so February 2020, and then they were put under ice because of the pandemics, with the general escape clause, but also with the suspension of the discussions and the public debate on the reform of the rules. We're going to start again this public debate in autumn. I think key in all this, looking forward, it has not been mentioned, but it is pretty evident from the question put in as a title of the seminar. So bringing it together or dividing ourselves is the issue of trust. So rebuilding trust is absolutely fundamental, and rebuilding trust is between member states and between member states and European institutions. So how do we do that at the first order level of generality? First, it is the next generation EU and recovery and resilience programs are absolutely key in this. If we implement them properly and we show that we are serious in doing that, I think we make a big jump forward. I think this is important for the member states, so especially the large recipients. And here I look naturally at Rome and Spain and Madrid, who are the largest recipient of the transfers. So they have combining their investment and reforms. So the two R's of the recovery and resilience. And second, obviously, it's important for the Commission. The Commission has to do, as we are doing now, a very serious assessment of these programs, and will have to be serious in the implementation of them. So this is the first point, looking forward. The second point, we need more ownership at national level of what will come out of the review and the fiscal rules. I think, and this is true particular for high debt countries, I think there has been some proposals, including by French economist Jean Pisani-Ferry et Ali, on more decentralization, on implementation of the fiscal rules, more empowerment of independent fiscal authorities, possibly the need for more differentiated targets for debt, given in a debt anchor, given the large differentiated position amongst member states. So more ownership on the part of the high debt countries. Third point, acknowledgement by Germany, Austria, et ali of the PENC impossible trinity. So you cannot demand at the same time and plead for early exit of the ECB, no central fiscal capacity, and strict enforcement of proscribing rules and early exit. This simply does not hold. So I think acknowledgement of the essential element of this impossible trinity, I think, is key. And final point, as Thomas knows better than anybody else, to go from A to B, in Europe is never a straight line. Actually, if you try to take the straight line, you are most likely to fail. This to say that I think making the rules coherent with our green and digital ambitions, also with a green transition, with a new growth model, would require, I think, a lot of emphasis on investment, green investment, and high quality public finances. So this, I think, anchoring it more to the need to build this, build back better after the pandemic, and boosting investment on that front, I think, is probably a straighter way to put the focus on what needs to be done at the national level for fiscal policy, rather than going through the the classic analysis of spillovers in economic and monetary union. Thank you.
Many thanks, Marco. And I will now give the floor to Natasha, who, even though situated in Paris, has had a career both in the European institutions and back home, and others. But what I hope that you will also draw out is a look, let's say, from a specific member state, bringing also out the very divergent recommendations that we were receiving in the Commission, we were participating, and what the political, European political risks are, and how we should counteract them. Natasha.
Thank you very much, Thomas, and thank you, Dietmar, for organizing this. It's a pleasure to be together with Marco and Guntram on this discussion. And as Thomas said, we were colleagues and in this commission, which was a bit of a, let me give a little bit of context. I know it was done already, but I think the French authorities being very self-aware of the shortcomings of the French behavior in terms of public finances over decades, felt the need to launch this commission to which we were belonging with Thomas. For two purposes, really. One being more short-term opportunistic, and the second one being more of a sort of long-term signal to be sent. The short-term was to say, well, we have yearly to send documents to the Commission and to send signals to our peers in monetary union. So we want to send the usual, paperwork together with one report, which would sort of signal that we're serious about keeping public finances under control. So I think that was kind of a background wisdom that was in the head of the commissioners. But the second one was really to address a specific, a French-specific way to look at the role of the state and to look at how public finances are involved in the management of an economy. And I think here having Thomas on board, and we also had a German lady on board whom lots of you know, helped a little bit to balance the views and helped to shape, the conclusions of the report in a more, to my view, with my European eyes, a more balanced outcome. So I would divide my remarks in 4 points, really. First, to put fiscal policy in the ecosystem of macro policies. Second one is to give this Franco-specific regard on the conduct of public finances, and then focus on the risks in Europe in forthcoming quarters and years, on the solutions that we came up with in the report. But first of all, I think now in the post-COVID era, looking at fiscal policy really needs to be looked at in a new manner, because the ecosystem of policymakers has changed. Marco was saying it very, very clearly and very concisely. We know we need to have counter-cyclical tools, and those tools are done by fiscal policy and monetary policy. In normal times, it's easy. In current times, it's a bit more difficult. But the difficulty which comes in addition to this counter-cyclical logic is that we are in a crisis management mode, which, to my view, Marco, you came back to the beginning of the euro, but to my view, since 2008, we've been on and off on a crisis management mode, it being due to a sovereign crisis, to issues with the banking sector, issues with the financial sector beyond banks. And imbalances have piled up, are still there. And those imbalances are telling us, well, maybe it's not only about going back to counter-cyclical management, but it's about going back to counter-cyclical management with crisis management tools almost embedded in those dimensions. And what the game changer was, and to come back to the discussion in the Commission that you were mentioning, is the fact that monetary policy has changed completely. It's, if not its mandate and objectives, it's axiomatic. Because the scale of implementation tools has changed, because we now have they were intertwined before, but the balance sheet of the government and the balance sheet of the central bank, in our case the ECB, are deeply intertwined for the coming decades. And this is something we won't be able to ignore, even if and when we come back to a sort of new normal, which brings the central bank further away from public finances, or at least from asset markets that deal with sovereign bonds. This brings in questions about the independence of the central bank. Some people like to think about it, and Marco mentioned the fiscal dominance, but some groups that are not necessarily the best intentioned people towards monetary union are saying, well, the independence of the central bank is put into question, and therefore there's a deep political economy issue that is arising that should be dealt with in democratic, discussions, and has to do with who is the legitimate issuer of fiat money, for example. So here you have a lot of debates that are happening right now due to or thanks to, you know, technological innovation, the appearance of, you know, what is so-called alternatives to central bank money in the form of bitcoins or cryptocurrencies, and the democratic legitimacy of the central bank as the sole issuer of high-powered money is being questioned. And we should not underestimate the link between the conduct of fiscal policy, monetary policy, and those things that come from other circles. So that's the first point. The ecosystem has changed. In our debates in the Commission, it took a while for people to realize that monetary policy was really at the center of the way we should think about fiscal policy in the monetary union right now. So that was my first point. Second point is really about the conduct of public finances and the rigor in the conduct of public finances and the transparency. Again, Marco said very, very concisely, and I like this idea of saying we should not tighten too early. We should not normalize fiscal policy too soon, because otherwise we will jeopardize a recovery which is already, you know, a bit wobbly in Europe, and in relative terms between Europe and other areas in the world, the differential speed of recovery is showing up. So that's for sure. But we should also make sure that the key member states of the monetary union should behave in a responsible way. And this responsible way depends on country-specific circumstances. And those circumstances, again, Thomas was always giving the wise word when we were sleeping towards thinking about public expenditure as not being so much of an issue, and, you know, we may tax more to get rid of the debt, stock of debt in the future, blah blah blah. But in a country like France, and I think the report came out with a realistic view on this, even if debt is not the best metric to control the trajectory of public finances in the form of a rule, the initial debt level, the stock of debt itself, is a key initial condition for the sustainability of public finances in the future, in the case when market conditions may change. And in our current circumstances, we know, and I come back to the ECB, we know that the funding conditions of sovereign member states of EMU are being are being completely flattened, and expressions of national differences are being completely flattened by the ECB's policy. Now, this is not to say that, and here in terms of horizon, it may come relatively soon. I mean, in a year or two, nothing can be excluded in terms of market behavior towards debt issuance of countries when the central bank is not there to buy the net supply, and when, you know, investors, international investors, can arbitrage between different options for investing their money in safe assets. Another dimension of being responsible is to have a longer term perspective, looking into the future. That's the reason why there will be this exercise of thinking again about the rules that we want to adopt in the future, but also thinking back about the past. And thinking about the past in the case of France, objectively, there has been a continuous deterioration of public finances. So the lack of control over public expenditure is something that has become a bit of a behavioral symptom. And even though the political willingness may be there to change this, history shows us that for 20 years plus, there have been ratchet effects in the level of public expenditure in France. So here, really, the thinking has to focus, and it's true for every country, really, even the most disciplined ones, about the governance of public finances and the governance of public expenditure. So I know the clock is ticking, so I still have a couple of minutes if I stick to the time. The risks that we see if that does not happen, or if this implementation of discipline. I don't like the word discipline because it's connotated, but of good governance and responsibility in public finances. I think the risk is of two dimensions, and this is why it is of interest for all the euro area as a whole. The first one is the risk of sovereignty. Countries that do not control their market conditions because they do not control their expenditure, they run the risk of losing their sovereignty towards, at least towards their creditors. And the second one has to deals with the perennity of the euro area. The elephant in the room, the fact that EMU is not complete. But I leave Guntram maybe speaking about it, so I leave it there. So finally, what solutions with this very long-term perspective, having in mind the behavioral symptoms that we have, from the part of various member states. I completely agree with Marco in saying that the central fiscal capacity is of the essence. We've made baby steps towards it. We should keep this ideal in mind when we construct Europe in the next 2 decades. The common issuance, it's a little miracle that we have it now. It is still meant to be temporary. But again, it's up to us to make sure that, I repeat a bit what Marco was saying, but that next gen EU is spent wisely, that all recovery instruments are really show signs of us collectively being able to exploit network effects and externalities of economic nature, of financial nature, but also of political and cultural nature. For what regards the rule, the review is to come, and Marco is completely at the core of it. But simplicity is of the essence. I agree with the Thomas. How did you call it, Marco? I don't remember. the Thomas addendum, or the visa earmarking, that it should be dilemmas. Exactly. So if you give up on simplicity, so we should not give up on simplicity, but I think switching to expenditure instead of focusing on debt might be a good compass, and having a very long pluriannual conduct of public finances at the national level together with the community level. And you said something, Marco, which I think is an essential underlying common denominator to all of us, which may be the key to bring everybody together around the table, is the fact that in Europe we're well positioned to think about growth in a way which is an alternative way to what we've seen in the past decades, conceiving a model for capitalism that goes beyond, financial capitalism, that includes a degree of responsibility that would help us having a very resilient growth model, potentially higher potential growth, and therefore make public finances more sustainable, and Europe a place in the world where our values are met by the way we conduct our economic activity together. And here, I think there are some initiatives, there are some legislative exercises that are being reviewed at the community level right now. I have in mind all the legislation of extra financial reporting and accounting. I have in mind the legislation on the risks mapping in the financial sector. Those are tools that will help us make a proposal for a model of capitalism that is in line with our values and that is providing for more sustainable growth and for alternatives to what is still being offered in other areas in the world. And with this, I'm done. Thank you, Thomas.
Many thanks, Natasha. Guntram, over to you for a broad poly-country, multi-instrument policy view.
Well, thank you so much, Thomas, and thank you so much, Dietmar, for the invitation. It's great to be here and see all of you again, even though only in the chat. It would have been much nicer to see each other actually in Vienna and discuss these issues person to person. But okay, Zoom is what we do nowadays. And a lot has, of course, already been said. So what I thought I would do is perhaps try to talk a little bit more about the politics of it all, because in a sense, I think we all more or less have a pretty good understanding of the technical issues. And I think Marco's framework of explaining the basic assumptions of Maastricht and then showing where are the limits of those assumptions in today's world, I think that is quite widely shared, even though of course there are differences on the details. But let me perhaps give you my quick start, still as an economist, start with the economics, give you my 3 quick economic points, and then give you a little bit of a flavor of where I see the political debate at the moment. So I think on the economics, it seems to me there's really 3 things that have changed quite substantially in the last years. The first one is that the famous R minus G, meaning the difference between the interest rate and the growth rate, has become more favorable than it used to be. And all the forecasts that we have are very positive on this, very favorable on this. What does it mean? Well, it basically means that debt dynamics are more favorable. You need to run lower primary surpluses, lower fiscal surpluses to sustain the same level of debt that is sustainable. And that, in a sense, provides fiscal space and renders the high debt levels that we have less high than we used to think they are. And that's important because our framework has very much been centered around in a world where R minus G looks very different. And now this R minus G term has become more favorable, and that provides fiscal space, which by just looking at the stocks of debt to GDP ratios isn't quite as high as it actually is. So this is an important, I think, change. The second important economic change is, and I think many of you have talked about this already, both Natasha and Marco have talked about this, is of course that monetary policy is in a very different place than where it used to be. It is at the zero lower bound, meaning monetary policy can actually do quite little to steer the macroeconomy at this stage. It can support fiscal policy, but it cannot seriously lower interest rates further if there was to be a new economic shock. So basically it is constrained. And so as monetary policy is more constrained, fiscal policy plays actually a bigger role in classical macroeconomic stabilization policy and should play that role according to most modern textbooks, I would say. And I would say the third point, and I think that point wasn't yet really mentioned, is that we are actually at a moment where we have a massive transformation of our economies ahead of us. And here, I think in particular about the greening of our economies, that is a stated political goal for the next 10 years. Now, if you take that serious, it is something that will affect all areas of economic policy making. I think we have barely started to understand the scope of the transformation that will have to happen in the next 10 years. It is massive. It affects every area of economic, public, and private life. And so all public policy makers will have to think very carefully about how this affects their frameworks. And in our context, it will affect fiscal policy making in numerous dimensions. I mean, one important dimension, and that is perhaps not the focus of today's discussion, is taxation policy. The taxation framework needs to change to incentivize green investment and disincentivize brown investment. That is quite a big thing. I mean, it also involves subsidization policies, which are really quite important. We still subsidize brown technology to a very large extent, even though we know that we need to phase it out rapidly. And so shifts in subsidization policy will be quite important. But equally important, there will be a need for major investments. And these are private investments that need to be incentivized by taxes, but also a lot of public investments, because a lot of the public infrastructure that is needed for a green economy cannot be provided by the private sector on its own. It will have to be provided by the public sector, simply because the private sector cannot internalize these externalities. And so there is a clear role for public policy and public fiscal policy here. And why does that last point, and let me spend a bit of time on this investment point, because I do think it actually does not get sufficient attention in the debate on the fiscal rules. I do think it is actually an important reason why our fiscal framework needs to adapt. And the reason is simply that the current framework essentially treats a spending on an investment as it treats a spending on a current consumption of the government. And why is that? Well, basically, both increase ceteris paribus, increase the deficit the same way, while the benefits of a consumptive government spending occur in the year in which it is spent, while the investment benefits occur over a decade or even 3 decades. So there's a clear mismatch here that, if I'm a policy, and here's the political economy, if I'm a politician that has to decide whether I increase the pension of my citizens by 100 euros per person, or whether I actually invest into, let's say, a green infrastructure project that will benefit the next 30 years, well, the cost is the same. Let's say the cost is the same, but the political cost of not doing the pension and instead doing the investment is actually huge. And so inherently, our fiscal framework has a bias towards short-termism, short-term spending, and not towards the long-term transition needs that need to happen. And so that's why, I mean, I would really, in the whole rules debate, put quite a bit of emphasis on the necessity to rethink our framework, to incentivize long-term green investment in particular, because that will be the goal of our generation and the generation of our children, to decarbonize our economy. So this is I would say broadly on the economics, where I stand on the economics of all of this. On the political economy, I mean, we haven't heard much about the political economy so far, even though I thought we would focus on this quite a lot. But of course, on the political economy, I think one key issue is always, how do various parts of Europe see the current debate that we are having? And can only sort of en passant mention that I gave an interview the other day to a Finnish newspaper, explaining why Next Generation EU is actually a good thing and is actually helpful for the European Union as a whole. And I got lots of social media activity in Finnish that didn't sound nice. So that's just a sort of very simple reflection of the political economy of what's going on. But I would say to a North European eye, a lot of the fiscal rules reform debate that we are currently hearing, and we are interestingly mostly hearing it from Southern Europe and possibly France, sounds awfully ungrateful. Awfully ungrateful in the sense that there has just been the biggest, and now I'm speaking sort of explaining from a North European perspective, there's been the biggest bailout in the history of monetary union called Next Generation EU, has just been agreed. And the first thing that is asked after that is a fiscal reform debate that will provide more fiscal space and less rigidity to Europe South. So that's the way it's seen in parts of Northern Europe. While of course the picture from parts of Southern Europe is exactly the opposite, that we are basically in a period or in a decade of fiscal mismanagement because of too intrusive and too inflexible rules that have actually aggravated the recessions and actually been pro-cyclical and prevented the south of Europe to recover quickly from the great financial recession, and now we may be risking a similar mistake again as we emerge from the COVID recession. So this is really two very divergent narratives on fiscal policy, and I think Marco knows exactly what I'm talking about, and Thomas as well. I mean, both sides come from very different perspectives on fiscal policy making and on the rules at this stage, and that makes all these reform debates extremely difficult because I think, Marco, you mentioned trust. I mean, because trust isn't quite where it should be. I mean, in theory, as economists, many of us can agree what would be the optimal solution. But in practice, if countries do not trust each other and do not trust the institutions, then it's very difficult to actually come to a sensible conclusion. Now, let me perhaps offer one sort of final thought of some optimism, and the thought of optimism I would end with is that I do think that the last year's fiscal policy making in the Eurozone has been markedly different and markedly better than it used to be post-financial crisis. And I think I would basically start my positive assessment with the time of the Juncker Commission, where we entered a period where there was, I think, yes, there was a complicated fiscal rules framework, but yes, there was also an understanding that there's a need for fiscal policy to play its part in ensuring a recovery. And there was also an understanding that gradually we need to also do our homework in terms of the deeper structural reforms that trigger growth and improve growth. And as the pandemic struck, it seems to me the EU reacted with a remarkable degree of flexibility and capacity to deal with the situation. I mean, there was very quick decisions. Of course, there were very sort of painful months during 2020, during which, politically it was very difficult to come to an agreement. But, eventually, if you take sort of a step back and look at the year 2020 now, I would say it's been an incredible year in terms of striving, finding the right political compromise and agreeing on a compromise, and agreeing also that it is crucial that money that is being borrowed at the EU level with Next Generation EU is being spent well. And arguably, the governments we have now in place are extremely in favor of good governance and implementing spending well, so that growth rates increase and do not decrease as a result of that spending. And here I would in particular point to the positive example that we might see now in Italy, but also in Greece. I mean, which I think is really quite a hopeful signal. So at the end of the day, I wonder whether, I mean, I think I talked already too long, but I think at the end of the day, I wonder whether sort of the excessive emphasis on the sort of whether the emphasis on the rules and the details of the rules, and the fact that they are very sort of complicated and all of this, whether that emphasis is perhaps excessive, and whether what really matters and what we really should be focusing in is the politics and the political economy and the capacity of institutions to drive intelligent debates, political fights in the Council, in the European Council, so that outcomes actually become better than they used to be. And I think there is some optimism that in the last years, that overall the situation has actually improved. Let me stop here.
Thanks very much, Guntram, and others. So in the interest of time, I'm recalibrating what my intentions actually were. I will give a very short personal impression in summarizing. Then I will try to summarize the different questions that we have received and put them to the three of you. So I think there seems to be quite agreement amongst the three of you on the short and medium term fiscal trajectory. Overly simplifying, don't consolidate too rapidly in view of where monetary policy is, but also so as not to run into a macroeconomically undesirable situation, but rethink significantly the structure of government expenditures. As Guntram was saying, massive investment needs ahead, greening of the economy, digitalization, etc. So, and debt sustainability issues are not what they used to be. Natasha will remember that we've received advice that French debt could easily be sustainable at 350% of debt to GDP. That was, of course, an American intervention who have a different setup, but we had also very opposite advice. But debt sustainability is not what it used to be, but in terms of prudence, in terms of risk management, you've got to keep more than half an eye on the rear mirror, inter alia, because of possible spillover effects within monetary union. Now, what I'm concerned about is less the issue if the trajectory of fiscal policy is so or so or so, but what is the political consequence if the approach of important governments to fiscal policy over the medium term differs significantly. If we have one country that is very rapidly bringing their fiscal stance down to zilch, zero, and you've said enough on what you think individually for that country, but for European politics, what is the consequence if other countries are following other advice, good or bad, and have a completely different trajectory? And as it may happen, it could possibly even be those countries that have a lower debt to GDP level that are consolidating rapidly, and vice versa. So what we need is not only, I believe, a new approach to fiscal rules, but we need a debate about a more common principles, more common approach. And in order just to be, not to be too polite, for many budget ministers, I would wish them to become finance ministers. But that's, okay, that's Christmas. That's like asking Guntram to learn better Finnish so as to understand all the comments that you've been receiving. Very deplorable, your bad Finnish. So, as a language, no? That is my take on the situation. Now, to paraphrase what different people have been asking in the Q&A, Axel Hörhage has posed a couple of questions, inter alia, harking back, as does Charlie P., harking back to 2008-10, was the insistence, especially of the German authorities, on extreme tightening of deficit rules was that not counterproductive? Or should we actually be applying these rules? So what kind of fiscal normalization should we be aiming for, and what is your view on the sequencing of monetary and fiscal normalization? Peter Austin is asking a question on building back, or I prefer to say building forward better. How should one adjust the rules in order to strengthen the green economy, reducing socio-economic discrepancies? And Mickey Landesman is reflecting on a rejuvenation of the golden rule to include human capital, training, and other issues. Natasha will be smiling. We discussed all of these issues in our commission, and different structure of investment compared to what it was 30 years ago was one of the issues that most colleagues there were emphasizing. So a footnote, given the huge transformation costs that we're facing, we will need a rejuvenation, a pickup of capital markets in Europe, because just relying on public budgets, forget it. So last round, please, Marco, Natasha, and Guntram, maybe more on the political risks and how can we overcome them? How can we achieve a joint effort, a joint understanding, which leads to a more collaborative approach on fiscal policy and avoids the brouhaha that we were facing a couple of years ago? Marco.
Okay, no, thank you very much. Okay, first of all, let me say that, I mean, listening to you now in your summing up and listening to Natasha and Guntram, I find that I mean, at least the perimeter of the endeavor that we have in front of us, I think, is shaping up reasonably in a reasonably agreeable manner. Now, I think the several issues raised are, require very deep thinking. I mean, the whole greening of the economy that you mentioned, I think there was one of the questions, and Guntram, I think we have not processed this thoroughly yet. Because I mean, the transformation need here will be indeed massive. I think they will, think it's not only the impact on the fiscal rules and on fiscal policies throughout society. I mean, the boundary that has been shifting between market and state. I mean, the fact that is not sufficiently thought about. I mean, these technologies here, green, but I put also the second transition, which is the digital one, will have massive agglomeration effects. So we will have to take care of that also in order to to go forward in let's say in an harmonious manner. When we think about the quality of public finances for the greening, indeed, I think it was mentioned. There was Michael Landesman. I mean, reading at the comments. I think we'll need to have the tangible and the intangible also being factored in. At the same time, you cannot translate that simply in a in a golden rule, because you would exempt from what you are targeting, very, very large sum of money, which I think will not going to be, which is not going to be a feasible one. So in all, I think it requires, I think, a good understanding of the challenges in front of us. I think the willingness, I would say even the generosity to look at this in a holistic manner. I would agree with you, Thomas, that establishing behavioral principles, so economists would say the reaction function of governments, I think it would be a good way forward. I mean, you can, of the various questions and comments, I mean, I go back to the trilemma which I attributed to Lucio Penck on that I outlined before. I mean, you cannot have these various things hanging together if one wants to have, relying on something which is, if you want to have some rules which are essentially prevents from doing certain things, then you need to have inevitably something at the central level that takes care of that, and you do not want to have the ECB back against the wall at the effective lower bound. So, I mean, on my final comments is on again on the greening of the economy and the golden rule, a special treatment of certain public finance programs. I mean, in the past, there has been always in a number of quarters skepticism because of moral hazard. So greenwashing, things that would then be in an opportunistic way governments would exploit. I wonder whether this fear of moral hazard, in the light of the challenges that we have in front of us, the genuine challenges that we have in front of us, is really something still we should absolutely be scared about in such an absolute way. If you put together an agreement of the challenges and where we want to go, an agreement on principles of behavior that we have talked about, I think we can probably devise something which is more resistant, more robust to moral hazard than we have had in the past, and rebuild, trust at the same time. The very final point is on Guntram. I have to say, okay, you had a rough encounter with a Finnish audience. I have to say that from Eurobarometer and other surveys, at least so far, maybe next month is going to be different, but Next Generation EU as an expression of solidarity, or even better, enlightened self-interest, I think is pretty popular amongst frugal countries also. Now, obviously, what you put forward, what you put the emphasis on, which is good spending and good reforms, is absolutely essential. That's why there is this positive interactions that I mentioned in my first intervention between implementation, serious implementation of the recovery and resilience programs, and the creation of this good feel atmosphere and this trust, which would allow also to approach the reform of fiscal rules with more, let's say, togetherness. Thanks.
Many thanks, Marco. I think we have to be parsimonious with the time, unless Dietmar lets us run over by a couple of minutes. Natasha?
Yes, very, very quickly. So, sorry, I was disconnected a couple of minutes. But I think one key dimension of all this discussion that we have is that we've let ourselves be captured by an accounting view of our being together fiscally and economically. So we bogged down in accounting rules and so metrics and how should I say, ways to control each other and measure each other, whereas we've lost the compass that drove us together at the very beginning. namely the values that we want to express together as European citizens. And until we are able to bring the accounting back into the box of accountants, if I want to say that way, and focus on values, and that requires, us French accepting that a budget constraint is a budget constraint, however you look at it, at some, at the end of the day, it has to square. So bring the accounting back in the accounting box will help us, put the norms in the second stage and focus on meaning and values in the first stage. And to relate to what Michael Landesman is, hi Michael, we haven't been in touch for a long time, what was saying, I think writing, we need to tangibilize the valuation of those dimensions that we care about today. Give a value to nature, natural capital, give a value to cultural capital, to the wealth of nation in the broader sense. We don't have the metrics for that. The national accounting system doesn't allow that as it stands now. But I think a lot of work is being developed. At the moment, it's developed for firms, for companies, so in the private sector sphere, because companies are being pushed to be accountable for their environmental and social impact. But we should think about this also in the public sector sphere and develop a metric for the valuation of this natural capital and cultural capital and the educational capital will help us bring it back into a routine accounting system, so to say, that really takes those externalities into account. And we're not there yet. We're not there yet because it's a long journey, because we started with some, the work on SDGs has, made progress but shown limits, and we need to make this operational. And once we have this operational, we will be able to get back to say orthodoxy, but with peace of mind and the focus on values and sustainability in the future, à l'européenne.
Thanks a lot, Guntram.
Yes, thank you. So Thomas, I think on your question of different country approaches, my view is, first of all, that a decentralization of the framework would be a mistake. So I don't agree with the Pisani-Ferry et al. Approach there. I think we are in a monetary union, we are bound together, and so decentralization risks even less coordination. So I'm quite skeptical about this decentralization approach in the fiscal policy making. And I think to illustrate that, let me just point out that the divergence that would be implied by a rigorous application of the German debt brake on the one hand, and a flexible interpretation of EU rules in Italy, would be, to my mind, quite an issue for Europe's monetary union. So now I'm not saying that this is going to happen. On the contrary, I think there is now strong political forces in Germany that tend to think that we will need to find ways softening the German debt brake, and I think it will happen. Both the Greens, but even the Liberals, are now openly talking about the need for major investment budgets, and if the rules do not allow them, perhaps somehow outside of the accounting framework. So that Natasha referred to. So I do think there is some understanding there. But rigorous application following only national logic, I think, would create quite a bit of problem. I mean, in a monetary union, we are quite bound together, and so we need to, I think, create this space where fiscal policy is not just a national matter, but is being debated at the EU level, and where ideally legitimate institutions at EU level drive debates among countries and within countries. So that's I guess the first point. Then there was a question on the speed of fiscal normalization, and where should we fall now? it seems to me that the EU recovery is somewhat slower than that of the US. It is faster than that of the UK, interestingly. So it's not a monocausal thing. It's not just driven by differences in fiscal policy approaches. It's driven by lots of different things. But I do think it would be a mistake to tighten fiscal policy prematurely. I mean, we are clearly not yet back at closing the output gaps. So I would advise against premature tightening. And the last point, there was the question on the green fiscal rule, and all this question about is it a problem if we exempt significant parts of spending from the rules? And there I would say, well, I mean, if those parts of the spending are investment related and have positive productivity effects, then I'm much less worried about this. Now, then the question is, for the greening, how much of a positive productivity effect does it have? And if it doesn't, I mean, then of course there are competing goals here. I mean, there's the debt sustainability goal, and there is the sort of green spending goal. But I think we need to also be upfront and clear and frank that those goals are actually then competing goals. And if I can just add that point, the last ruling of the German Constitutional Court on the rights of future generations in terms of greening our societies now, and the fact that we do not do enough is actually an infringement of the rights of the next generation. I find that a fascinating judgment, because it really shows that we have, I mean, in the German constitutional order at least, we have now sort of two sustainability goals here, right? I mean, we have a debt sustainability goal, and we have a green sustainability goal. And to the extent that those two are competing, we'll have to find the right way of trading off those two competing interests. But perhaps I'm a little bit more optimistic. I do think that quite a bit of the green spending will be I mean, at least if we do it well, will be not negative on growth, but a positive on growth. And if it is a positive on growth, then the trade-off is much less significant. Let me stop here.
Thanks very much. I think we've outlasted our welcome, or at least we've full capacity utilization of the time slots that we were allocated. Many thanks for this. I think what we've seen is that very specifically for the Euro area, also for the EU, but even more so for the Euro area, very, very important fiscal policy questions to be answered over the next months. The more politicians work off a common framework, the higher is the likelihood that there will not be significant policy divergence, because the more policy divergence there is, the more conflicts will emerge and spill over into other areas. So important discussions that hopefully are taking place and should come to a good conclusion, which at a very general level is that if we recognize that there are significant policy spillovers, and if we recognize, as we have done with Next Generation EU, if we recognize that in such situations a high degree of solidarity is called for, then we have to put into question some of our concepts, or some people's concepts, on absolute sovereignty over our fiscal policy, which puts into question, of course, how do governments, national parliaments, and the public interact with their partners abroad. Important questions. I hope we've provided some stimulus for further thinking, and for those of you in the policy world, hopefully also for further acting. Many thanks, Dietmar. If you want, I would hope that you say a few words as well.
Many thanks, Thomas. Many thanks to all of you. I don't want to add anything to that. I think for those who have doubted at the beginning, that fiscal policy could make for anything but a very boring discussion, you proved the opposite. It was really, I think, a very broad but in-depth discussion on what the real issues are. And it's not about accounting, it's about the future of Europe. Thank you very much to all of you.
Thanks a lot.
Thank you. Thank you.
Thanks.